Well, for the second week in a row, the average interest rate for a 30-year fixed-rate mortgage in the U.S. has dropped. It's sitting at 6.64%. Last week, it was 6.65%. And a year ago, it was at 6.82%. So generally, it's been trending down since about mid-January when those rates were above 7%. And of course, lower rates are going to make it a little easier for those looking to buy a home. Now, we're also seeing this with 15-year fixed-rate mortgages. The average rate there has fallen to 5.82% this week. It was 5.89% last week. And a year ago, that rate was averaging 6.06%. So a lot of factors influence these rates. Things like what bond market investors are anticipating for inflation in the future, the demand for U.S. Treasury bonds globally, and what the Federal Reserve decides to do about its interest rate policy. It's interesting, though. The decline that we've seen this year in the average 30-year mortgage rate has really moved pretty much in sync with what's been happening with the 10-year Treasury yield. And wonder is they often use that as a guide when they're pricing your mortgages. That 10-year Treasury yield was almost at 4.8% back in the middle of January. But for the most part, it's been on a downward trend ever since. This is partly because we've seen signs of a slowing economy, and there are also concerns about how those tariffs the Trump administration put on globally imported goods, how they're going to play out. Will they hurt economic growth? Could they fuel inflation? Well, right after that latest tariff implementation, a pretty significant one from the White House, we saw a big sell-off on Wall Street. And that actually made the 10-year Treasury yield fall to 4.06% on Thursday. This was because bond investors started putting more money into the idea that the Federal Reserve might actually have to lower its main interest rate if the economy starts to really struggle. Now, Joel Berner, he's the senior economist over at Realtor.com, he made the point that the 10-year Treasury yield has actually kept falling. This was as of this morning. He said this is because investors are pulling out of stocks, and he thinks this means that mortgage rates will likely keep going down over the next few months. He also said that we're going to see the effects of this all over the housing market for the rest of the year. It's interesting to consider that, a lot of housing economists were forecasting that the average 30-year mortgage rate would stay at around 6.5% this year. So now we have to see how things play out. It makes sense that when mortgage rates go down, home sales could go up because it becomes more affordable to buy a home. But here's the other side of that. What if a lot of Americans are nervous about losing their jobs or seeing their stock portfolios shrink because of the economy, and they might not buy a home even if those mortgage rates are lower? And Mr. Burr, he even said, but we don't really know yet if these lower mortgage rates will actually get people to buy more in 2025 or if the bigger economic picture will slow things down. And let's not forget the U.S. housing market has been kind of sluggish since 2022. That's when mortgage rates started to climb back up from those record lows we saw during the pandemic. In fact, last year, sales of previously owned homes in the U.S. were at their lowest point in something like 30 years. Now, falling mortgage rates and a larger supply of homes nationally did help sales go up a little in February compared to January, but they were still down if you look at them year over year. And on top of all that, even if mortgage rates do keep dropping this year, the prices of homes are going up, so that's making homeownership more expensive overall. Redfin has data showing that the average monthly payment for homebuyers in the U.S. hit a new high. It was $2,802, and that was in the 4 weeks leading up to March 20th. Then we saw mortgage rates take a sharp dive, especially on Thursday after the Trump administration made that announcement about tariffs. Mortgage News Daily reported that the average rate on that very popular 30-year fixed-rate loan actually dropped by 12 basis points, ending up at 6.63%. That was the lowest rate we had seen since all the way back in October. The reason behind this was all the selling that was happening in the stock market that Thursday morning. It pushed a lot of investors towards the bond market, and that caused bond yields to go down. And you always have to remember that mortgage rates tend to follow the yield of the 10-year U.S. Treasury note pretty closely, and those rates had been trading within a fairly narrow range since the end of February. Matthew Graham, the chief operating officer at Mortgage News Daily, he said that even though there are still a lot of unknowns about all the details of that tariff announcement on Wednesday afternoon, the markets were definitely getting ready for how it might affect global trade. It's pretty interesting how this rate drop is happening just as we're entering what's usually the busy spring season for the housing market. But Mr. Graham also pointed out that there are a bunch of other things going on that aren't helping buyers, and they're making it really hard to afford a home these days. Looking at even more recent data from Redfin, their report showed that the typical monthly payment for a home buyer in the U.S. reached a record high for the second week in a row. Again, it was $2,802. And this is in the 4 weeks ending March 30th. The report emphasized that even though that weekly average mortgage rate of 6.65% was one of the lowest we'd seen since December, it's still way more than double what those rates were during the super low period we had during the pandemic. And this is all happening as sale prices had gone up by 3.4% compared to last year. So even with that little drop in mortgage rates on Thursday, about 70% of households in the US, which is roughly 94 million, can't afford a $400,000 home. And just to give you a sense of where things are, the National Association of Home Builders estimates that the median price for a new home in 2025 will be about $460,000. When you look at how to calculate this, they take into account income levels and credit standards. And their report also said that if you want to buy a $200,000 home with a 6.5% mortgage rate, you need a minimum income of $61,487. They estimate that in 2025, something like 52.87 million households in the U.S. will have incomes below that, meaning they can really only afford homes up to $200,000. We are seeing more homes coming onto the market, which is good, but the problem is that this new supply isn't necessarily in the price range where most people are looking to buy, which is at those more affordable prices. And on top of that, the total number of homes available is still much lower than it used to be. This is mostly because we just haven't built enough homes since the Great Recession. Nat Ferris, a Redfin agent in Northern Virginia, said that inventory is definitely up. And in the past year or two, he's been contacted by tons of people who are thinking about selling their homes. Mr. Ferris thinks that some sellers believe the market has peaked and they want to sell now to get the highest price they can. He also mentioned that in the Washington, D.C. area, some people are selling because they're worried about losing their government jobs or because they want to move closer to the city because of new office policies. If we look ahead to the spring season, Realtor.com's data shows that new listings in March were up 10% compared to last year, and active listings were up almost 28% year over year. At the same time, we're seeing homes stay on the market longer and more listings are having their prices reduced. Pending sales, which are the signed contracts for existing homes, were actually down 5.2% in the biggest metro areas in the U.S. compared to March of last year. The cities with the biggest drops were Jacksonville, Florida, and Miami, Florida. They were down 15.1% and 13.7% respectively. And those markets have softened a bit, partly because people are moving back to where they lived before the pandemic. Virginia Beach, Virginia also had a pretty big drop of 14.2%. Danielle Hale, the chief economist at Realtor.com, she said that because it costs so much to buy a home right now, and with all the economic worries people have, we might see a slower start to the spring buying season. This Hale did point out that the market is going through a rebalancing right now, and this means that buyers have more choices. On a positive note, she wrote that those recent improvements in mortgage rates could be a good sign for the later part of spring and the early part of summer. But that all depends on whether those economic concerns ease up and don't scare buyers away. Now let's talk about those tariff increases that were announced on April 2nd. If they stay in place, they could be a big problem for the U.S. economy. We don't have all the details yet, but we're probably going to see U.S. real GDP growth forecasts for 2025 and 2026 revised downward. And we're also probably going to see a similar amount of upward pressure on inflation. But exactly how this will affect inflation and monetary policy really depends on a lot of different factors. What we do know is that the risk of a recession has gone up because of these tariffs. But if there is a recession, it might not last too long. The bigger problem is that if these tariff increases stay in place for a long time, they're going to permanently lower U.S. real gross domestic product. And when that happens, the average American standard of living goes down too. And one thing to keep in mind is that these tariffs are much larger than what was included in a weight of economic forecasts. Of course, it's only the tariffs that actually stay in place that matter. But unlike what happened with Canada and Mexico a month ago, there's not much reason to think that these new tariffs will be reversed anytime soon. They might get reduced a little, but it doesn't seem likely that most of them will be removed. Tariff threats have often been used to try and achieve different goals in geopolitics. We saw this a lot during President Donald Trump's first term, and the beginning of the second term seems to be the same way. Remember when tariffs were put on Canada and Mexico for a few days, but then quickly taken away after Mr. Trump said he got what he wanted on border security and other things? But on April 2nd, what Mr. Trump was saying was all about using tariffs to fix the U.S. trade deficit and make U.S. manufacturing as strong as it used to be. He's talked about this being his vision since way back in the 1980s. And now, unlike during his first term, he's surrounded by people who believe in this vision too. So it looks like these tariffs are here to stay. When you combine the tariffs announced on April 2nd with other recent announcements, the average U.S. tariff rate could go up by about 25%. That would put the overall average U.S. tariff rate at around 27%. That would be the highest it's been in over 100 years. How this will all affect inflation and monetary policy, aside from what it does to GDP in the short term, depends on a whole bunch of things. One big question is whether the money that comes in from these tariffs will be given back to people through tax cut. If that happened, it wouldn't completely get rid of the negative effects on economic efficiency, but it would help to balance out the drop in demand, and that could lower the chances of a recession. Right now, there's so much uncertainty among businesses and consumers, and that can have a really negative effect on how much people spend, even if you don't consider the direct effect of the tariffs themselves. result. So the drop in demand in the short term could actually be bigger than the disruption to supply, and that could mean that the tariffs end up causing a recession instead of just inflation. But on the other hand, if all the money from those tariffs goes towards new tax cuts, it could actually cause a lot of inflation. This is because the demand side of the economy would get more support. When you look at it from a monetary policy point of view, if we have tariff increases without more tax cuts, and if all this uncertainty makes people spend less, the Federal Reserve might have to cut interest rates more than they were planning to. But if those tariffs end up making things more expensive, the Fed might have to hold off on cutting rates for a while. So what have we learned? Well, even though we've seen some good news lately with mortgage rates dropping a bit, which is helping some potential home buyers, we still have the bigger issue of home prices going up, and that's making it harder and harder for people to afford a home. Then you add in these new tariffs, which just make everything more uncertain, make it hurt economic growth and drive up inflation. And who knows how that'll affect the housing market. The way all these things work together, mortgage rates, home prices, and all the economic policies, it's something we're going to have to keep a close eye on for the rest of the year. If you're finding all this info helpful, please do me a favor and like and subscribe. That way you'll get more updates as all of these economic forces play out. Thanks for tuning in today. Farewell.